Hello, savvy savers and future planners of Singapore. It's Iggy here from Investing Iguana, your trusted guide in the world of finance and investment. Today, we're tackling a topic that's crucial for every Singaporean's financial well-being: CPF interest rate shifts, what Singaporeans need to know for 2024. In this episode, we're diving deep into the recent changes in the CPF interest rates, understanding how these shifts affect your CPF accounts and what they mean for your future financial planning. With my expertise in financial trends and economic policies, I'll help you navigate these changes and provide insights into how you can adapt your strategies for optimal benefits. Whether you're planning for retirement, saving for the future, or just keen on making the most of your CPF funds, this video is tailored for you. So, let's get started and unravel the mysteries of CPF interest rates together. In the past 2 decades, Singaporeans have become accustomed to relatively stable interest rates on their Central Provident Fund (CPF) accounts. Historically, the ordinary account (OA) has offered a floor interest rate of 2.5%, while the special account (SA), Medisave account (MA), and retirement account (RA) have traditionally provided a higher floor interest rate of 4%. These rates, once considered satisfactory in a low-interest rate environment, are now being reevaluated in light of the global financial landscape's dramatic shifts over the past 2 years, which have rendered these minimum rates less attractive. As of July 2023, CPF members began to notice a shift in their SA and MA balances, which started earning more than the floor interest rates. This change is attributed to CPF's formula-based approach for determining interest rates, reflecting market dynamics. If the calculated rates exceed the floor rate, CPF members are credited with the higher rate. By January to March 2024, the interest rates for the SA and MA had escalated to 4.08%. Recent developments in CPF interest rates. A significant development occurred in the CPF interest rate review for the first quarter of 2024. The RA interest rate peg was realigned with that of the SA and MA. This shift from an annual to a quarterly review regime implies that the RA interest rate will now be updated more frequently, ensuring alignment with the SA and MA rates. 3 key implications for CPF members. 1. Alignment of RA with SA and MA interest rates. With the implementation of the quarterly review system, RA interest rates will now synchronize with the SA and MA rates. This change reflects the similar objectives behind these accounts, primarily geared towards supporting retirement adequacy. 2. Responsiveness of RA interest rates to market changes. In an environment where interest rates are on the rise, the approach of reviewing rates on a quarterly basis allows retirement account (RA) rates to adapt more quickly to these market rates. This means that if the market rates increase, the RA rates will also increase in tandem, ensuring that the returns from the RA remain competitive and reflective of the current market conditions. On the other hand, if there is a decrease in interest rates in 2024, the RA rates will not remain static at a previously calculated 4.08% for the entire year. This is important because if the RA rates were to remain static while the market rates decrease, the RA would be providing a higher return than the market, which could lead to imbalances and potential issues. Instead of remaining static, the RA rates will adjust according to the prevailing market conditions. This means that if the market rates decrease, the RA rates will also decrease accordingly. However, there is a safeguard in place in the form of a 4% floor rate. This means that even if the market rates fall below 4%, the RA rates will not go below this level. This provides a measure of security and assurance for those relying on the RA for their retirement needs, as they can be confident that their returns will not fall below this specified rate. 3. Comparable returns for RA and SA. Given the more restrictive nature of the retirement account (RA) compared to the special account (SA), it is reasonable to expect that the RA should offer returns that are at least equivalent to those of the SA. This is particularly relevant in a context where interest rates are rising. The RA is more restrictive in terms of the conditions for withdrawal and usage of funds, as it is primarily designed to provide for members' retirement needs. On the other hand, the SA is meant for long-term investment and retirement-related financial needs, but it offers more flexibility in terms of how the funds can be used. In a scenario where interest rates are increasing, if the RA were to offer lower returns than the SA, it could potentially discourage CPF members from maintaining their funds in the RA. This is because they might perceive that they could earn higher returns by keeping their funds in the SA, despite the greater restrictions associated with the RA. Therefore, aligning the returns of the RA with those of the SA in a rising interest rate environment ensures that CPF members' funds in the RA are not disadvantaged compared to those in the SA. This alignment not only ensures fairness between the two accounts, but also helps to maintain the attractiveness of the RA as a retirement savings option for CPF members. Future outlook and observations. The next Central Provident Fund, CPF, interest rate review is scheduled for March 2024. This will be a significant moment to observe potential adjustments in the retirement account, RA, interest rates. Given the dynamic nature of the financial market and the quarterly review approach adopted by the CPF, there could be changes in the RA interest rates based on the prevailing market conditions. This review will provide an opportunity to assess the effectiveness of the CPF's approach in ensuring that the RA rates remain competitive and reflective of the market rates. It's also noteworthy to mention that the ordinary account, OA, interest rate hasn't risen in line with the special account, SA, Medisave account, MA, or RA. Despite fluctuations in the market rates, the OA interest rate has remained at the 2.5% floor rate. This is because the OA interest rate is determined by a different formula compared to the SA, MA, and RA. The formula used for the OA yielded a rate of 0.66%, which is significantly lower than the floor rate of 2.5%. As a result, the floor rate of 2.5% continues to be applied to the OA. This ensures that CPF members continue to earn a minimum guaranteed interest on their OA funds, regardless of the lower rate yielded by the formula. Broader financial context. In addition to the changes specific to the Central Provident Fund, CPF, there has been a broader shift in the financial market, particularly in the rates for fixed deposits and high-interest savings accounts over the past 2 years. This shift is significant and represents a change in the financial landscape. Fixed deposits and high-interest savings accounts are popular financial instruments for saving and growing money. The interest rates offered by these instruments are often reflective of the overall health of the economy. When these rates shift, it indicates changes in the economy, such as inflation rates, monetary policy, and overall economic growth. Over the past 2 years, these rates have been shifting, which could be due to a variety of factors such as changes in the monetary policy of the central bank, inflation rates, or the overall state of the economy. This shift could mean that savers and investors are now getting different returns on their deposits and savings than they were previously. For CPF members, this shift in market rates is an important factor to consider in their overall savings and retirement planning strategies. The returns on their CPF accounts, particularly the retirement account, RA, special account, SA, and ordinary account, OA, are influenced by these market rates. Therefore, changes in these rates could affect the growth of their CPF savings. With recent changes in CPF interest rates and the evolving economic landscape, it's crucial to strategize your CPF investments wisely. Let's break down the key components of CPF investment strategies for 2024, leveraging my experience in financial planning and investment analysis. 1. Understanding CPF interest rate changes. The CPF interest rate shifts, particularly the new quarterly review system for the retirement account, RA, special account, SA, and Medisave account, MA, are significant. While the ordinary account, OA, retains a floor rate of 2.5%, the SA, MA, and RA rates have seen an increase. In 2024, it's essential to monitor these changes closely as they directly impact the growth of your CPF savings. 2. Maximizing your CPF accounts. Ordinary account, OA with the OA interest rate at a constant 2.5%. Consider using OA funds for long-term investments under the CPF Investment Scheme, CPFIS. This could include investing in low-cost index funds or ETFs that historically outperform the OA interest rate over the long term. Special account, SA. The SA offers higher interest rates, making it an excellent tool for retirement savings. Given the more attractive rates, transferring funds from the OA to the SA could be a prudent strategy for those not planning to use OA funds for housing or education. 3. Balancing risk and reward. When investing CPF funds, especially under CPFIS, it's vital to balance risk and reward. Younger CPF members might consider a more aggressive approach, given the longer time horizon, while those closer to retirement may prefer more conservative investments. Always align your investment choices with your risk tolerance and retirement goals. 4. Diversifying your investment portfolio. Diversification is a fundamental investment strategy that involves spreading investments across various asset classes to reduce risk and potential losses. The saying, "Don't put all your eggs in one basket," aptly describes this strategy. By diversifying, you're not relying on a single investment or asset class for your overall returns. If one investment performs poorly, others might perform well, balancing out the overall performance of your portfolio. In 2024, diversification remains a key strategy for investors. This involves spreading your investments across different asset classes such as bonds, equities, and perhaps a small percentage in gold or other commodities. Diversification helps mitigate risk because different asset classes often perform differently under various market conditions. For example, when equities are performing poorly during a market downturn, bonds might be performing well, and vice versa. Similarly, commodities like gold often perform well during periods of high inflation when both equities and bonds might be underperforming. 5. Keeping an eye on market trends. Stay informed about market trends and economic indicators. Global and local economic developments can impact investment returns. Staying informed about market trends and economic indicators is a crucial aspect of managing investments. Market trends refer to the general direction in which the prices of investments are moving. These trends can be upward, bull market, downward, bear market, or sideways. Understanding these trends can help investors make decisions about when to buy or sell investments. Knowledgeable helps in making timely adjustments to your investment strategy. 6. Preparing for retirement. For individuals who are nearing retirement age, the focus should be on preserving capital. This means safeguarding the money that they have already saved and accumulated over their working years. The goal is to minimize risk and avoid significant losses that could jeopardize their financial security in retirement. One way to preserve capital is to consider shifting towards more conservative investment options. These are investments that are generally lower in risk compared to other types of investments. Examples of conservative investment options include Singapore government securities, SGS, and high-grade bonds. Singapore government securities are debt securities issued by the government of Singapore. They are considered to be very safe investments because they are backed by the full faith and credit of the Singapore government. This means that the government guarantees to repay the principal and interest on these securities. High-grade bonds, also known as investment-grade bonds, are bonds issued by companies or governments with a low risk of default. These bonds are rated by credit rating agencies, and those with high ratings are considered to be high-grade. These bonds offer lower yields compared to lower-rated bonds, but they are also less risky. The priority for those nearing retirement should be to ensure a steady stream of income post-retirement, rather than pursuing high-risk growth. While high-risk investments can offer higher returns, they also come with a higher risk of loss. For those nearing retirement, a significant loss could be devastating and leave them without sufficient funds for their retirement years. 7. Understanding CPF Life. CPF Life is a crucial part of retirement planning for Singaporeans. It is a life annuity scheme that provides Singaporeans with a monthly payout for as long as they live, starting from their payout eligibility age. This scheme is designed to provide financial security and peace of mind during retirement. Understanding how CPF Life works is key to making informed decisions about your retirement. When you turn 55, a retirement account, RA, is created for you, and savings from your special account, SA, and ordinary account, OA, are transferred to your RA up to the full retirement sum, FRS. When you reach your payout eligibility age, you can start receiving monthly payouts from your RA under CPF Life. And that wraps up our detailed exploration of the CPF interest rate shifts and what they mean for you in 2024. We've journeyed through the changes in the SA, MA, and RA interest rates, dissected the implications of the new quarterly review system, and discussed strategies to adapt to this evolving landscape. As we've seen, staying informed and understanding the nuances of these changes is key to effective financial planning. Remember, these CPF shifts are not just numbers, they're pivotal elements that can shape your financial future. This is Iggy from Investing Iguana, bringing clarity to complex financial topics and helping you make informed decisions for a secure future. Stay tuned for more insightful analyses, and remember, in the world of finance, knowledge is your most valuable asset. Until next time, keep planning, keep saving, and stay financially savvy.